7 out of every 10 stocks in the Nifty 500 are in the red. And this is happening at a time when global markets are moving up. By mid-January, the cautious optimism with which markets entered 2026 is already being tested. So what's behind this slide? Is this the start of a longer phase of weakness, or just an early year wobble that corrects itself over time? Let's analyze in this episode of Markets This Week. Over 70% of stocks in the Nifty 500 have delivered negative returns so far this month. The Nifty 500 index itself is down about 1.6%. The Nifty 50 is also lower, down roughly 1.5%. That makes this January one of the weakest starts for the market in recent years. January 2026 is the second worst January start in the last 5 years. Only January 2025 was worse, when nearly 88% of stocks were in the red. Now, in contrast, between 2020 and 2022, more than half the market actually gained during the same period. What makes this more uncomfortable is that this isn't a global sell-off. While Indian markets are struggling, global equities are doing much better. The S&P 500 in the US is up nearly 2% so far this year. Japan's Nikkei has surged more than 6% year-to-date. Now, there are three big pressure points holding Indian markets back. First, heavy foreign investor selling. Foreign investors have been pulling money out, chasing better returns elsewhere, and turning more cautious on emerging markets. Second, global trade and tariff worries. Concerns around US trade policy have resurfaced, weighing on export-linked sectors and overall market confidence. Third, muted earnings momentum at home. Corporate earnings growth has slowed, and expectations for the current quarter remain modest, keeping buyers on the sidelines. Meanwhile, global markets, especially the US, are benefiting from policy support and AI-led rallies. India is simply not part of that trade right now. So what, if anything, could turn that sentiment around? Two things now matter most. Corporate earnings. While banking and some defensive sectors are showing resilience, a sustained earnings revival is still uncertain. Union Budget 2026. Markets are watching closely for tax certainty, a continued capex push, MSME support, and possible tax tweaks. But with fiscal constraints in place, no big bang stimulus is expected. At best, the budget may trigger sector-specific moves rather than a broad market rally. For now, market analysts see this weak start as a sign that Indian equities may be entering a phase of lower returns, more realistic valuations, and a sharper focus on fundamentals. In other words, this is a market that's rebuilding its base, not one that's ready to sprint. And it's a reminder that markets don't move in straight lines. In phases like this, patience often matters more than hype. Follow for more market insights.